Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to today's episode of the Prime Property Finance Podcast. In today's episode, we've got with us Daryl Norkett of Shawbrook Bank. He's going to chat to us about all things lending from a lender's perspective. Great conversation. Daryl's extremely experienced in the world of property, doing his career through Barclays, Shawbrook, Lendwell, and then back to Shawbrook. In this episode, we cover off loads of topics ranging from commercial valuations, supported living, what it takes to make a mortgage product, the thought process that go into that, some of the thinking around underwriting and the considerations when lending out money to borrowers and everything in between. So yeah, really enjoyed this week's episode, speaking to Daryl. Plenty to unpack. Let's get straight into it. Hello and welcome to this week's episode of the Prime Property Podcast. My name is Mark and with me today I've got Daryl Norkett of Shawbrook Bank. Hi Daryl.
Hello. Hi Mark. Pleasure to be on.
Yeah, thank you for joining us. Really appreciate you giving us the time. Yeah, we'll dive straight into it. Let's keep this reasonably quickly paced, I guess. Do you just want to give us a quick introduction of yourself and your background, etc.?
Yeah, so I'm Daryl. So my current role is Director of Real Estate Proposition at Shawbrook Bank. So I look after all of the kind of customer-facing loan products that we offer across bridging, buy-to-let and commercial. I've been in property finance and commercial finance my entire career. Started off at Barclays Bank. Had a first stint at Shawbrook working directly with brokers and customers on deals. Had a stint at setting up a brand new non-bank lender called Lendwell during COVID. Bit of a COVID business, that one. Doing mostly small developments. And then rejoined Shawbrook in the middle of 2022, just before Trussonomics and the world went crazy. So it was great timing.
Yes. So I bet that was... baptism of fire back into the corporate world.
Absolutely.
Yeah, fantastic. And that's probably a great place to start, really. I've got a number of questions around some of the technicalities of how mortgages come to be, the processes that go into it, and just to try and help the listeners have a bit of an understanding as, a bank just doesn't turn up with an interest rate and try and sell the money, etc. There's quite a lot that goes into that, and we'll come on to the Liz Truss bits and how that played around with it. But could you just go into just explaining a little bit for us then around what actually goes into making a mortgage product in the first instance?
Yeah, well, it all starts with you need to understand the types of customers you're going to lend to, the types of securities you're going to lend on, and how you would manage those loans to be successfully paid interest and ultimately help people successfully repay the loans in the future. You've got to remember that as a bank, we're lending out retail deposit money. So we're trusted by the J Public, essentially putting their hard-earned money into the bank for us to lend it back out to the investors who need it. And we've got lots of regulation in place to make sure that we do that safely and that depositor's money isn't going to be lost. And obviously, there's actually, since 2008, very few examples of where that system has sort of failed. And even, if I kind of come outside of the Shawbrook bubble and think about a non-bank lender, it's exactly the same with whether that's family office money that you're trusted with or a bank's funding line or whatever. It's kind of exactly the same. So you need to understand your customer. You need to understand what you're doing so that you can be trusted that the decisions you make and the due diligence you carry out means that everyone's going to ultimately get paid and successfully go off and use those loans as intended. Bad debt very, very, very quickly eats away at a lender's profit margin. So no one can afford to have much of that.
Yeah. No, that's a good point. So in my HSBC days, I can remember, so everybody would get lauded for obviously the deals that were £1 million plus and so on and so forth. You'd invariably lend those monies at fairly low margins. So the profits wouldn't necessarily sit in those loans, but they're big numbers to sit on the balance sheet and get applauded for. And I can remember my risk manager at the time saying, don't take your eyes off the small stuff. because if you lose a £50,000 loan, the amount of capital you've got to put back out at the skinny margin means probably £5 to £6 million capital back out just to recover that 50,000 capital loss. So,
and that's why all mortgage products or all lending products start with understanding the market that you're lending into and how you can do that safely. And then you kind of go into whether the opportunity is there to kind of scale it, whether it fits with your business model, people, systems, technology, your ambitions around the pace that you want to build that book, and the margins that you're able to earn, which are ultimately set sort of by the market rather than an individual lender.
Yeah. Okay. Well, that's perfectly then into pricing. So how would a lender typically price mortgages? Appreciate different lenders are funding differently. Should we just touch upon that a bit?
Yeah, so a non-bank lender could be funded in many, many different ways. If it's kind of private money or family office money or something, then that's just down to the risk appetite of those people who want to deploy the capital into those loans. That's unusual though, because that sort of cash is finite. There's not lots of it out there. So typically, most non-banks will take funding lines from banks. So at Shawbrook, we offer funding lines to lots of other non-bank lenders, and that'll be done on a set price point between the bank and the lender. And then the lender will need to find ways to lend that money out with a margin on top in order to remain profitable. And those sorts of facilities are normally pegged against something. So it could be a margin over the base rate. It could be the swap rates. If you're doing kind of 5-year fixed rates and things, could be kind of anything, all down to each individual funding line and non-bank lender and what terms they've negotiated. Banks is probably a little bit more complicated, but fundamentally are funded by retail deposits. So when you Google, what's the best 1-year fixed rate savings account or ISA or whatever it might be, broadly that's all real. That's kind of what banks are paying for money. So at the moment it's kind of 4, maybe 4.5% for 1-year money. And we need to lend that out again with a margin in order to remain profitable. And it gets a little bit different again when you get into longer term fixed rates, because in the ideal world, you would go out and say to the savers, can I have a 5-year bond, please? So they give us the deposit and they stick it with us on a 5-year commitment. But in reality, not many of the deposit market savers want to do that. They only want to commit the money for 1 year, or they want easy access. Yet on the lending side, the majority of people want 5-year fixed rates from us, sometimes even 10-year fixed rates. So there's a mismatch between what borrowers want and what the savers want. And the way that bridge is gapped is using something called hedging, essentially, which is swapping out short-term commitments or variable rate money on the money markets for longer-term commitments, where the person on the other end would look to make kind of a small margin in the middle, essentially. So that's why you see lots of commentary now on LinkedIn from brokers around kind of 5-year swap rates and things, because it's kind of a bit of a guide as to whether interest rates are moving up or down for your typical mortgage customer.
Yeah. No, that's really useful because, swap rates are becoming more and more prevalent, certainly more knowledgeable for professional landlords. And it's a conversation that we have. I mean, we constantly get asked, where do we believe interest rates are going to be at the end of the year? Should they fix now? Should they be on a tracker? Are rates going to come down, etc.? I don't think I've ever got it right, but I have my own personal opinion. But then economists rarely get it right as well, because there are so many factors that drive interest rates, inflation, global events, and so on. But what's really interesting there is that swap market, which bridges that gap. So it's really good to understand what that is. Also, interestingly, as you say, it doesn't strictly follow the Bank of England base rate. In fact, I was looking at a graph yesterday, which shows that, yes, whilst you will see the base rate, or the base rate has come down recently, you will still see a small degree of volatility within the swap market, not as big as it was when you mentioned Liz Truss's comments a couple of years back. But yeah, so we do see it largely falls in line with it, but there are peaks and troughs in that as well. Speaking of Liz Truss as well, obviously we're all aware that there was that sort of mini budget, if for want of a better word, that happened, which sent the mortgage market into a bit of a spiral. It was absolute chaos, I'd say, for the best part of 9 months. Arguably, we're still feeling some of the effects of that, although I don't think it's fair these days to continue to peg that on that conversation. I mean, there's other things that are going on in the world now which superseded that. that has fundamentally changed the mortgage market from what we can see as brokers. And we saw the introduction of arrangement fees, much larger arrangement fees, which compensated for the interest rates because there were concerns over affordability and so on and so forth. Do you want to just talk through that and how that has sort of shaped what mortgages now look like versus what they looked like 2, maybe 3 years ago?
Yeah, so I think the high arrangement fees, lower interest rate products have been quite controversial. So I still get lots of feedback from brokers or borrowers saying, "Oh, crikey, I fell off my chair when I saw the size of that arrangement fee." However, I think they have been a useful tool, because what we've effectively seen is mortgage rates go from kind of in the threes to sort of up in the sixes and the sevens, and then sort of back down to the fives. Now, if you think about that from a landlord's perspective, that's kind of like a 60, 70, 80% increase in your interest cost. And most of these mortgages are interest only. So it's that increase is literally one for one. It's not like a residential mortgage where you're paying back a lot of capital every month and the interest is a relatively small part of the payment. So you're insulated a little bit from payment shock. The landlords felt it really, really sharply. Rents have gone up, which is great, but they haven't gone up at the same pace that interest rates have gone up. So I think what the higher arrangement fee rate products have done is they've enabled the lenders to then offer the interest rate at a lower amount in order to help the landlord remain robust, profitable and affordable. So not every deal, certainly in the current market, not every deal needs it anymore. Property rental yields have recovered to the point where in many regions it probably works on kind of standard products again, but still in London in the southeast or on a higher value property area, maybe out somewhere else, they're a useful tool. And I think if lenders are doing them correctly, and I believe quite strongly in this, and we've worked really hard to make sure this is always the case at Shawbrook, it should not be about making more or less money on the product the customer chooses. It's about offering maximum customer choice. But the amount they pay over the fixed rate period should be broadly the same, whatever option they choose, whether they choose to pay that monthly by a higher rate or whether they choose to pay that upfront by adding it onto the loan for a bigger fee. Depends on what that particular customer's needs are and what suits that landlord. But I think more choice, not less, is the way forward. And actually, it just means the broker's role is even more important because there's even more products to kind of work through and figure out what would best meet that particular person's needs.
Yeah, absolutely. And, it's no surprise that when you work out what the arrangement fee is, add that back into the actual interest rate, those products all cost the same. You've got a slight variance because there is a compounded element, I suppose. If you add the fee to the loan, you're effectively borrowing that arrangement fee. And that brings me on to another point then, I guess, around the arrangement fee is a lot of the conversations we have is where you've got people who have perhaps in the higher loan to values ranges, the 75s, the 70 to 75s, and they want to add a 5, 6, maybe 7% arrangement fee onto their mortgage. Some lenders will enable you to go over the published LTV by adding the fee on, but that comes with a health warning in so much that if the property value doesn't increase by the percentage over the max lending, then you'll either be stuck with that lender going forward. Now, that might not be a bad thing. Alternatively, you'll need to pay that down if you were to go somewhere else because your LTVs will be skewed. You'll be outside of the maximum thing. So I think great tools, as you mentioned, just use sensibly, and it does come with a degree of a health warning. Those in the 50, 55% have little to worry about on that front, So that's interesting. No, thank you for that. Really appreciate that. And then, so talking about the volatility that happened in the swaps, and we did touch upon how you create products and you price. How were you dealing with the volatility that initially happened, and what does that look like? Because there's a degree of volatility now, but perhaps not as bad as it once was. So what does that look like then and now?
Yeah, well, at the height of the mini budget, I'll never forget that day because we had to change price. We had a choice, really. We took all the products off the market, which is what some lenders decided to do, or we got everything repriced basically overnight. Because our cost of funds was surging, absolutely rapidly, and we would have been underwater had we not done anything. So we took the decision to try and get the reprice done quickly, which is what we did, and stayed in the market. But we're probably changing price points every few weeks during that period of time as things kind of shifted around. I would say for the last year or so, there's a lot of volatility by historical standards. So by historical standards, the 5-year swap barely moves, to be honest, month on month. At the moment, I'd say the 5-year swap has been around 4% for about a year. Sometimes it's 20 or 30 points over 4. Sometimes, like it is at the moment, it's 20 or 30 points below 4, which swings mortgage pricing around a little bit. But we're not talking about enormous swings. So for us, it's been about setting price points that we can kind of keep out there and avoid this sort of repricing every few weeks and provide a stable, reliable, consistent product offering to the market. Because I think the challenge of the volatility on the investor side is when you're trying to scope out a deal, see if it stacks, do I want to make an offer for this property or not? Understanding your finance cost is a key component of that. So I think as lenders, if we can try and be as consistent and stable as we can, it helps people plan. And I think that helps more deals happen.
Yeah. And I guess Shawbrook is, as you touched upon earlier, is because of the bank and because of the way you're funded, you've got the ability to have a degree of control over that because, as you said, there's retail deposits as well as the swap market, whereas some lenders are wholly dependent on the swap market. And we will see those lenders change rates far more frequently than banks typically.
Yeah, absolutely. We do have more control. We've got a big balance sheet, and we're fortunate that Shawbrook has grown to quite a big business and very well developed treasury functions. So that now enables us to be more resilient during these periods. But not immune from enormous volatility like back in the end of 2022, but certainly with where things are at the moment, I think we've had a good handle on it for a while now.
Yeah. Okay. Thank you. Thank you very much for that. So, Shawbrook, we spoke prior to us starting the podcast around, where Shawbrook positions itself currently, and you mentioned about professional landlords, and we'll come on to that in a bit more detail shortly. The reason I brought that up now is just to dive a little bit into the underwriting process or the underwriting thinking that happens when you get presented a deal. So, back in the day when I was back in HSBC and we were underwriting deals, now this was on a commercial basis. We would work off certain lender acronyms to help us just formulate our thought processes, if you like. One of the very first things we would have a look at is the person. So regardless of how good the deal looked, the first thing that would get our attention is who are we dealing with, what's their expertise and so on and so forth. Do you just want to run through sort of the underwriting thought process that comes from a bank perspective as to when you get presented with a deal, where do you start and what are you actually looking and thinking about?
Yeah, and I don't think that, if I think back to my Barclays days, a bit like your time at HSBC, Mark, I don't think it's that different. It's just risk appetite varies and is rapid. It's very different at Shawbrook compared to what it was at Barclays. But yeah, we always start with the borrower. How much? What do they want to borrow? What do they need the money for? What are they trying to achieve? We're very much a relationship lender. Now, sometimes that means we're doing a big deal. We go up to 50 million. We regularly do very large ticket loans. Well, clearly you want to know your borrower really well if you're putting that much money out the door. But also for us, we have lots of customers who only do day-to-day loans with us, but have done many over many years in order to grow their businesses. So actually, when you take a step back, they've got quite a big exposure. So for us, sort of understanding what people are trying to achieve and how they run the business is always important, but it gets increasingly important as the exposure builds, because the more and more trust we're putting in that person to manage that business well and continue to be able to pay the mortgage monthly. So that's, you sort of start there. The asset, as a real estate lender, the asset is important. You would probably flex your appetite around the asset a bit more than you would around the person. So what I mean by that is if we've got an asset with some question marks on it, perhaps it's not had the best valuation commentary, we're more likely to kind of push the boat on LTV or affordability for someone that we understand has a robust wider business, isn't just reliant on that one property. We'll kind of look at the bigger picture. But all assets kind of vary, quite a lot. So we'll be a bit more conservative with stuff where the value is a bit more volatile. So, the value of a shop, in a secondary parade is going to perform very differently in an economic downturn to a semi-detached house in the middle of London, that kind of thing. So there's an element of that goes into the thought-making process. But we try and be as consistent as we can. And the reality is that most of our lending is still up at kind of 70-75% loan to value. But we get there because we know the people we're lending to and we back the wider business that they've got.
Yeah. Okay. Yeah. No, that's interesting. So in regards to valuations then, a lot of the thinking that I sort of try and put myself in the lender's shoes whenever you're speaking to clients, we kind of sit in the middle of that conversation. So we understand and empathize with the client, and we also understand and empathize with the lender. And sometimes we're the mediator in these conversations. I've always taken the stance really that, from a lender's perspective, you want to understand if everything goes wrong with this property, ultimately, how can you get out of that loan? And what is your chance, or what is the probability of not ultimately losing money, which comes back to the losing of the capital on that. So is it fair to say that that's ultimately the baseline decision making is, in a default position, what do we stand to recover as part of that?
So sometimes it's more important than others. So, majority of customers and deals fit the mold. People have got good credit histories, they run good businesses, their outside portfolios meet a stress test, there's surplus income there's track record over a number of years, and the asset they're giving us is valued up just fine, and they want a normal LTV that we publish and is available as part of the criteria. So that's the majority of what we do. I think where the razor sharp focus on what would you do to recover your money if this went wrong comes in, tends to be on the bigger transactions or the stuff that is highly specialist or highly speculative. So I'll give you a couple of examples recently, but we had a deal in credit committee that was a block of very, very, very high value flats in Kensington a few weeks ago. And yeah, clearly we've got the borrower and the deal's got to stack up. But at the end of the day, it was a lot of money out on some high value units. And a lot of the discussion and decision making was, right, well, actually, if this borrower fails, which might be totally out of their control, how do you go about getting your money back? Because putting 7 or 8 high value flats in an auction room isn't going to work. We'll lose, we will 100% lose money if we do that. So what would we do? So a lot of the conversation went around whether or not we could get comfortable on what our exit strategy would be in that kind of doomsday scenario. Equally, did a very large loan last year on some an old prime retail parade in Scotland that has some planning to develop into a hotel. It's a similar thing. There's lots of if, buts and maybes around, whether or not the borrower can manage the demolition they needed to do, whether they can get the development finance they needed in the timescales they need to exit, lots of these kind of variables. So that's another sort of type of deal profile where you go back to, right, well, what would we do if that plan doesn't work? What are the other options? What are the contingencies? How would we get out of that loan? How would we not lose any capital? So that is really important on those kind of more marginal, more creative, more specialist deals. But I'd say the majority, it doesn't need to go that far because the fundamentals are strong enough that we wouldn't overly concern ourselves about that sort of forensic analysis on a doomsday exit.
Yeah. So from a lender's perspective, from a borrower's perspective, obviously they need to, as part of their due diligence, are going to consider some of these factors. I'd argue that many people can be overly optimistic when it comes to borrowing, and obviously there's a bias towards their own deal or their own property and so on. And sometimes, I guess, will lend purely or look to borrow purely on a criteria basis, as opposed to, does the deal stack? What's my stress level on interest rates? Some of the conversation we will have with investors is, so it used to be when base rate was, so when interest rates were around your 3%, that people would stress test at 6%. I would argue that's just an arbitrary figure. You need to stress test to a point that it falls over to understand how much stress or how much slack is in the deal. So if your failure number is 12, you know that you can ride 5, 6, 7, 8 base rate increases before you seriously have to consider doing something different to the property. Do you see much of that happening, or do you not see that side of the conversation? You ultimately just get it presented to you either via us or via a broker, or do you actually get involved in some of that conversation as well?
We probably see the outcome of that conversation by what the broker's putting forward and asking for us to do or recommending for the borrower. I think everything's different. I mean, a lot of the time the sort of affordability buffer, if you like, in the deal just comes down to the asset. So if you've got a buy to let, in the middle, a semi-detached house in London, for example, and you need to get a reasonable amount of leverage on it, the chances are, because of where rental yields are, is that you're not going to have much room on the stressing at all. But then you can protect yourself by taking a longer term fixed rate. And also, if it did go wrong and you needed to sell, that sort of property is pretty easy to sell. So you wouldn't be overly concerned. Whereas if you're doing a HMO in the Midlands somewhere, you should have loads of buffer. And if you don't, why don't you? What's going wrong? Is it an overly optimistic GDV or value that you're putting forward? Are the rents wrong? Is something wrong? Are you not thinking about some of the costs that you've got for running that property? Because fundamentally, yields are so strong there that you should have lots of room. So I think the asset drives that a lot of the time, as much as anything else.
Yeah. Okay. Yeah, and that brings me on to then something that we get asked a lot is around HMOs. And more specifically, the commercial valuation of a HMO. I guess there's a few school of thoughts in regards to this. So a property, if there's set criteria which says that anything more than 6 beds and above, or it's been altered to a certain standard where they're all en suite and so on, therefore making it that the income is intrinsically linked to the property. What I mean by that is that it's no longer a house that can just be let back out to a family of 4, for example. There may be Article 4 restrictions, which also will dictate whether that can or can't be used as a HMO and so on. So there are factors. Some people think that commercial valuations are potentially over leveraged. Could run you into a position where you're over borrowing against the asset by trying to eke out as much of that. So, for example, again, is another health warning that we provide is just because you can get a commercial valuation on a property today doesn't necessarily mean that commercial valuation is going to be available tomorrow if the market or credit appetite changes. And you could theoretically, unlikely, but theoretically be over borrowed if we go back to the vacant possession value. Shawbrook obviously do commercial valuations. What's the sort of viewpoint from yourselves in regards to, I know you publish the criteria, but where do you sit on the whole commercial valuation on HMOs?
Yeah, the majority of what we do on HMOs is a commercial style HMO. So it's probably worth just explaining sort of different types of HMOs, and the points you raise around the risk profile is spot on, Mark. We are eyes open to that. We do agree. So I think if you've got a very basic HMO, I lived in a student let, went to university in Norwich, and literally nice house, but all they'd done is taken the sofa out of the front room and put a bed in, and that was our HMO. We shared 2 bathrooms, 6 of us lived in the house, all that sort of stuff. That is not a commercial valuation. If that goes wrong as a HMO, the most likely thing is it gets sold to a family. Therefore, it should be valued as a house, like anything else. And actually, if it's 75% on a kind of C3 housing value relative to the size of other shocks we've had to the property market in the past, you're in a pretty good spot. And you've got an asset with a very large market that you can sell it into if you ever needed to. So that stuff's all fairly vanilla, fairly safe. What we see on the commercial HMO valuation, I don't think the number of bedrooms is that important. I know the planning class changes at 7 occupants to sui generis, and that does make a bit of a difference. But I think fundamentally it's about the property. So if you've got 5 or you've got 8, I don't think it makes much difference. But if you've got a property that has been highly modified so that a family could no longer live there. So the one you often see is, an extension out the back to get another bedroom in, loft conversion at the top to get another 1 or 2 rooms in, and en suites in every room. In some areas, you can do kitchenettes. In some, you can't. It kind of varies. What family is going to want that property? They just don't want all those en suites. It doesn't make sense. There's no family living space. The garden's normally tiny because it's been built over to get the bedroom on the back. It doesn't make sense. And the cost of putting that back to a family home is going to be enormous. If you spent 100, 150,000 doing the conversion, guess what? It probably ain't going to be much difference to put it back in. There's never... in reality, that's never going to work as a commercial strategy. That's always going to see everyone lose lots of money. So what we believe in at Shawbrook is that the demand for HMO rooms from a tenant's perspective is unlikely to go away. So we felt for a long time that the tenant demand is likely to remain. And that's because there's a shortage of rental properties. There's a fundamental supply and demand issue and an affordability issue for tenants, actually, where sometimes coming straight out of university or whatever, having a room for a while and saving that money compared to having a 1-bed flat is what they need to do. So the tenant demand is there. The risk on ours and the borrower's side around leveraging on that commercial valuation is just that it's fairly unproven as to when that HMO goes wrong and you take it into market, what does it trade at? there's usually not many comparables. It's usually all a bit theoretical. There's probably a big difference between a really nice HMO going to market because maybe someone just wants to move abroad or retire or whatever, versus a bank repossessing a HMO and going to market where every investor buying it is going to be thinking, right, I can get this cheap because it's in trouble, there's some distress, I can buy well on that side of the fence. So there's definitely some risk there. I think the bit that I always come back to that we spent a lot of time debating over the last year or so is whatever yield the valuers use, it needs to make sense. So the days of seeing these HMOs valued on 6% gross yields, to me, it makes absolutely no sense when you consider the work, capital, effort involved to achieve that 6% return versus going into the stock market or going into a deposit account. It doesn't make sense. But where you see them come back at 10, 11, 12, 13% gross yields, you start to think, right, okay, I can now see that someone might buy at that level because, yes, they're going to have to invest in capital. Yes, they're going to have some management expertise and effort, but they are going to get paid for it ultimately, which might support that valuation. So I think the yield is critical. And then it varies quite a lot area by area. So what you find in lower property value areas is that the investment value of the HMO, even with a sensible yield, might be as much as double that of the house next door. So then I think you need to think about, well, again, if I'm an investor coming in, am I likely to pay you double or am I likely to buy the house next door and renovate it? Sometimes the answer is actually paying double is better. That's cheaper. And then it sort of makes sense. Sometimes it's like buy the one and do it up next door is like half the cost of buying it new. And I can't see that. That doesn't really make sense either. So you've got that dynamic, I think, in the lower value areas. And then in the higher value areas, what you tend to find is the gap between the commercial valuation of the HMO and the normal C3 housing market is actually relatively small. So there is a premium, but it's not a massive premium in percentage terms. So again, you come back to, would someone buy a ready-made one without needing to do the effort of conversion? They might in those sorts of markets when you're looking at, £1 million valuation when a house costs you 800, 850 anyway, you might. So it's pretty complicated. It'd be a lot simpler if there's a lot more trading of HMOs going on to provide more comparables. But where we're at the moment, I think that sort of thinking is where we'd encourage all our underwriters to be on the deals that we do, acknowledging that we still do 75% loan to value on investment values on HMOs for the majority of our HMO lending, and the book performs really well because the tenant demand means that not many people go into arrears ultimately.
Yeah. Okay. No, really, really interesting. I've got a few questions, but I think just for the listeners' benefit, just to clarify really and to clear up the difference between, when we talk about commercial or investment value, that's a valuation based on the property's income that it generates, whether that be gross or net. Net may be a deduction for costs depending on how your leases look like from a HMO perspective, whereas most properties are sold on a vacant possession basis and are valued on a comparables basis. So simply what has a 4-bed semi-detached house sold for within a range of, 6 miles within the last 6 months, etc. So those are the two differences in comparables. Typically, you will see a higher valuation on the investment side because it's income driven as opposed to just family home comparable. Because another thing I think that landlords forget is that house prices aren't driven by landlords. Landlords want cheap properties. House prices are driven by home buyers and home movers who are buying under an entirely different set of principles and objectives, usually emotion and affordability. Off the back of that. So there's the difference between a commercial valuation that we're talking about and that of just a standard vacant possession comparables piece. What I found quite interesting actually when you mentioned about the yield and is it worth it, if you see 10, 11, 12s, ironically, people who are on a commercial valuation want to see that in the 9, 8, 7, 6. Because obviously that drives up their ultimate valuation. So it's arguably contradictory to they want to prove that it's not worth it for their time and effort, versus actually what you want to see as a lender to go, well, we want it to be worth your time and effort, so therefore 10, 11, 12 makes more sense.
Absolutely, and that's where the friction is. And areas tend to set their own levels as well. So we see 8.5, 9 quite a lot in Manchester, for example. Don't see it very often in Derby. So sometimes it's the areas that set it. And then also from the investor's perspective, the yield is only kind of one measure. I guess for every investor, the measure is, well, how much capital have I needed to invest? Deposit, build cost. How much of that have I got out on the refinance? What have I got left in, if anything? And then what's my return on that money? And if you look at it on that basis, majority of HMO investors are earning possibly infinite returns because they've got nothing left in it. Or if they've got a bit left in, it's not loads, and they're earning very, very high returns on their cash invested. So I think it's really important to not lose sight of that fundamental that makes that part of the market so attractive, and sort of chase ever higher kind of risk on valuations and yields. That means that if something went wrong, you're in big, big trouble, rather than just kind of managing a problem and recovering.
Yeah, and certainly from a HMO piece, as people move out of single lets and into more cash flowing properties, because of the, again, for it to be worth your time and effort as much as anything else. We have increasingly these conversations around trying to push that element. We covered on a previous podcast around my argument is ROI is probably the best metric to use. How much have you got left in there? What are you getting returned as a result of that? It probably enables you to benchmark that against other asset classes. So, if I'm only going to get 5% return, and you've mentioned you can get 1 year savings at 4.5%, what's the best option here? I appreciate we're not taking into consideration capital growth and stuff like that, but there's some bigger conversations to be had there. So on the HMO point, you spoke about obviously the commercial valuations and looking at that. And we did touch upon your sort of avatar, so your ideal client then, if you like, being professional landlords. Do you just want to talk us around sort of where Shawbrook positions itself in the marketplace for landlords?
Yeah, so see, there's loads of mortgage lenders out there for buy-to-let and commercial mortgages, but that's not the Shawbrook business. So we very much see ourselves as there to serve the professional landlords. So that can either be someone who's already operating full-time property business at some level of scale, but equally importantly, it's people starting out, but with that mindset, they want to build a property business and probably go full-time. That's very different to kind of buy-to-let back in the day, if you like, whereas kind of someone with a great job in the city, no intention of leaving it, and someone said to me, you know what, you should put some of your money in a buy-to-let because it's really easy and you earn loads of money and the property go up in value. That's a different sort of passive investment mindset. I think the market's shifting away from that, actually, towards professionalization of the landlord being a term that just means running the business properly, understanding compliance, understanding regulation, understanding how you make it profitable and sustainable. So that then means that the lending solutions that we provide are all geared around what can we do with our criteria, with our product design, in order to help that person who wants to be a professional landlord to grow more quickly, which often means leverage. So we just spoke at length about HMO valuations. Ultimately, that is about helping people achieve more leverage so they can recycle more of their cash, so they can grow their property business more quickly. On the bridging side, we've got a really popular product called Lending for Cost, which enables people to get up to 85% loan to value on day one by providing a bit of contribution up front to the refurb work. So again, that was put out there to try and help, because we know for someone trying to grow a property business, cash is their biggest barrier generally, because properties are expensive to buy and consume lots of capital. So we're very much trying to stay as close as we can to what all the cutting edge strategies are, the direction of travel for landlords, and then making sure that we kind of keep positioning ourselves to be there as a solution for that type of person.
Yeah, fantastic. And so just to come back to that 85%, so could you just run through that, breaking it down as to what that actually means? So you mentioned sort of your day one loan to cost, a few bits in there. Just for those that are probably less familiar with terminology like that, could you just sort of break down what that would potentially look like in, say, a BRR, buy, refurb, refinance? Yeah.
So that product's designed at the simple end of a refurbishment. So it won't give you as much leverage as a kind of mini development loan where you get drawdowns to fund your build work. So it's aimed at the simple end, but everyone does 75% loan to value bridging on the purchase price. And that's where this product starts as well. It's 75% of whatever you're buying the property for. Then we look at your schedule of costs, so how much you're going to spend on that property. You're going to do new kitchen, new bathroom, whatever. And whatever that number is, we'll lend you another 10% on the loan to value, up to 100% of the amount of the costs that you're going to spend on it. So we wouldn't go beyond that. But for most deals, it means you can use the full 10% because what you're spending is normally more than that. The total loan combined can't go above 85% of effectively the day one value or the day one purchase price, and it can't go above 75% of the GDV or the end value to make sure that you're at the right level to be able to get a viable exit. And so we launched that in 2018. It's got the benefits of just being really simple. You get all the money up front, so you don't have to wait for any drawdowns, no QS involved or anything like that. So it's just quick and easy for someone doing a light refurbishment. And obviously we hope that borrowers using that product might then stay with us to take a mortgage product out on the back end.
Yeah, no, and that's great because, invariably with these projects where you need to borrow for the works as well, development loans or refurb loans, whatever the label may be, you have to fund the first piece of the works in order to unlock the refurb element. So a lot of clients sort of miss that part. That could mean a difference in £10,000 to £15,000 worth of capital requirements, which you haven't budgeted for to actually cash flow the deal. So I guess what this does is effectively forward fund, means you don't have to do the arrears element, gives you 10% of that works up front, which then unlocks the rest of the monies then that are there as well. So that's super useful as well. In regards to that then on criteria points, anything else that you've got which are actively supporting your target audience?
So we've been gradually expanding appetite back on commercial property again. So it's a big part of what we do at Shawbrook. Traditionally it's mostly been landlords, so commercial investment products. We're back up to a maximum of 75% loan to value on most sort of mainstream commercial assets now, and offering interest only solutions on fixed rates, which again sounds quite simple because some of our peers do it as well. We're not the only one doing this, but it's fundamentally very different from the high street bank, old school commercial mortgage way, and it enables commercial landlords to achieve leverage, manage their cash flow and grow in a similar way to a buy-to-let landlord. And we're actually seeing lots of our buy-to-let landlords diversify into commercial and mixed-use property at the moment. So that's a super important area for us. We recently went back into the owner-occupied commercial mortgage market. So commercial mortgages for small businesses who want to buy a premises to trade from or want to buy another premises to trade from, or what we're seeing quite a lot of is a bit of a hybrid of I want to buy a parade of shops and some flats above, and actually I'm going to put my property business in one of the units and I'm going to let out the rest and whatever it might be. And that just felt, whilst it's a slightly different target market in that not all small business owners are professional property landlords, it felt like there was a lot of synergy for us in terms of kind of how our business is set up, being able to underwrite commercial property. Shawbrook's kind of DNA started off in that owner-occupied market, and most of the brokers that we work with also work with people looking for that type of funding. So that's something that's we started, launched it in May, and it's had a good start. I think on the buy-to-let side, I think our reputation as kind of a HMO lender and a bigger portfolio lender is pretty well established now, but we're still working really hard to try and stay on top of recent trends. Like we relaxed criteria on service accommodation a couple of weeks ago, so we could do some bigger deals that allow on a nightly basis. We do some lending for social housing, and I think we can do some more there to make that easier, as more landlords sort of see themselves as part of the solution in that part of the market. And part of my job and the team's job is to stay on top of this stuff and try and find these new areas as people are moving into them. Yeah.
And I'm just mindful of time as well. So we won't dwell on these topics too much, but you touched upon supported living. That's becoming increasingly a conversation as people move out of the traditional rental market, with all the challenges with the Renters Reform Bill or the Renters' Rights Reform Bill due to come into existence. What are you sort of seeing on from that perspective? We're having a lot of conversations with people. There's a lot of, I wouldn't say ambiguity, but there needs to be a lot of understanding around the relationship between the service provider, the registered provider, the subletting that goes on, who is your actual end user, vulnerable tenants policies that exist, and so on. Do you want to just touch upon that, because it's becoming a real hot topic?
So the fundamentals of that business model are quite straightforward. So for me, those assets are valued on a C3 basis. I know some people try and get a commercial valuation on the lease, but we don't really buy into that because it's just a house and hasn't got the intrinsic value of HMO that's been heavily modified, or a shop that's in the right location with a footfall, whatever it might be. So we think they are C3 houses on rent. So that bit of it's quite easy. I think the extra layers are that often these days the lease isn't to the local authority. If it was, I think life would be a lot easier. But it's not. It's to a registered provider who has to go through the local authority's vetting process, but often they are, shell company, limited track record, no balance sheet. So if they aren't paying the rent, kind of what happens next? I think that's an important part that people need to think about and make sure they would kind of know to what extent they could get out of that lease, how difficult would it be, what to do with the tenants, that are still in there. Clearly people with some vulnerable characteristics in the first place to need social housing. So the registered provider and the kind of structure of the lease is one bit. And I think the other bit for a lender that we just think about and always are trying to get ourselves comfortable with is just if that deal went wrong on us and we had to put a receiver in, we really don't want to be evicting those people. So what fail safes are there in practice? What would the local authority do? What would the registered provider do? So trying to give us comfort around those areas helps a lot, because that's not so much a credit risk, it's just a softer, we're not in business to be kind of going around chucking people in need out of their homes. So what mechanisms are there to make sure that can happen in an orderly fashion?
Yeah, and something else I've come across just recently as well is, if you are looking at a supported living provider, just check the list of services that they provide. So you might think that you're putting in asylum seekers, homeless, domestic violence, whatever it may be. So become as vulnerable individuals. But then further down the list, you might have residential childcare services, which is an entirely different proposition to temporary accommodation for vulnerable individuals. And we often fall into the trap where that service provider covers such a broad spectrum of services that actually they've ruled themselves out because of one section that, I guess, from your perspective, you don't, that's a heavily regulated business. It's an entirely different business model. And therefore, don't want to necessarily mix one with the other.
I think there's some natural tension there, because the registered provider will be thinking, well, I want as many things in my toolkit as possible. So if the council's needs and demands change, I want to be able to say, yeah, cool, got you covered, carry on using us to house for your housing needs. So I get it from their perspective. It's probably quite a tricky one to manage, but I think when you start going into things that require CQC registration, you are entering a different world where that effectively is care home regulation. And I think that does require a completely different skill set. People who run care homes don't see themselves as property investors. They see themselves as carers first and foremost, and as medical professionals. I think that's quite different from a landlord trying to pivot strategy. Yeah,
no, I couldn't agree more. I think we've got that examples of people who are very good at that model with childcare services and so on, and then we've got property investors who let their property out to third parties to ultimately operate it in a certain fashion. So that's really good, and I'm sure we could talk about that a lot more, but I'm just mindful that we need to draw this to a close pretty sharp. So just want to say thank you very much for your time, Daryl. Really do appreciate it, and great insight into the bank, the lender side of the conversation. We often talk to the landlords, but it's a really part of that. And is there anything that you'd like to mention or promote as a result of this?
No, just thanks for having us on, Mark. Great conversation. Really enjoyed it, and I hope listeners get something from it too.
All right, fantastic. Thanks very much, Daryl. Appreciate it.
Cheers.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.